Let me now bring on board Mohammed Apabai, Head of Asia Pacific Trading Strategies with Citi. Morning, Apabai. Good to have you back on ET now. Now, Mr. Apabai, there is no mystery in what is happening around us. Globally, things are sticky. Europe is in a mess. US economic data has been of late slightly choppy, and Asia is threatening to slow down. My question is, what will bail us out?
Well, I think in the immediate short term, what we're waiting for is some policy action. We're waiting for some resolution of what is happening in Greece, what is happening amongst the US financials, and what the central banks are likely to do. Clearly, the statements from the central banks, the Federal Reserve as well as the ECB, shows that they're very much on hold at the moment. Both of them are saying that if there is a problem, if there's a slowdown in the global economy, that they will react, but they're just reviewing what is going on right now. So we think that the third week of June could be quite an interesting week. We've got the US financials downgrades on June the 15th. We've got June the 16th as the US options expiry. We've then got the Greek elections on June the 17th, and then the weekend before we get to the Fed meeting on June the 20th. So until those 4 or 5 big events get sorted out, it's probably going to remain fairly turbulent in the near term.
Mohammed, of course, the bigger fear is the contagion risk that Greece actually proposes right now. Could we stare at a 2008-like situation?
It's possible that it happens, although that's clearly not our core scenario. Our view is that since 2008, the central bankers have very much understood the risks of not acting. So in 2008, at the time of the Lehman event, they were discussing whether they should be acting, and then at that time they were talking about moral hazard. Moral hazard is something that is very rarely talked about in markets at the moment. And so we do think that as the markets continue to sell off, there will be this liquidity put level, which we think is somewhere around 10% below where we are right now on major developed markets, probably a bit lower than that on the emerging markets, at which point the central bankers and the politicians will come back and they will act together. One of the interesting points, I think, is that until recently, there had been an agreement or an understanding between the politicians and the central bankers, in the sense that the politicians were going to go down this road of austerity, and the central bankers were going to ensure that things were kept on an even tack, at least in terms of financial markets. Recently, there seems to be, I wouldn't say a disagreement, but what I would say is a bit of a divergence, in the sense that the politicians are now moving away from the austerity measures. And so that's making the central bankers a little bit more hesitant in terms of acting. And certainly that's the case in Europe, not so much in the US.
So, Mohammed, to your mind, at these levels, what exactly are markets pricing in, and what are you advising your clients? Are you advising your clients that they should buy fear, or they should still exercise caution?
My view is that there is likely to be a very key decision point around this S&P 1285 region. We actually turned quite negative on markets on Monday. The reason why was because we had seen that people who had bought into the equity market since the start of 2012 were now going to start seeing losses. And at that point, what you start seeing is deleveraging going on across the market. So for now, what we are seeing is every rally is actually being sold into. 2 or 3% down from here in the major developed markets, what you're going to start seeing is people having to decide whether they're going to double up on positions that they've owned since the start of the risk rally in October of 2011, or whether they sell those. My view is that given the elevated levels of money market stress, we are likely to break down through that level, and potentially the sell-off could extend for another 10 to 12% below where we are right now. And at that point, it really will focus the attention of the central bankers. Unfortunately, in Asia, we're going to see much more of a convex movement than that. And we're probably likely to see much more significant losses. But we're also quite concerned about the way that the financial CDS is moving. If you look at the implied probability of default for not only Spain, but for some of the US financials, some of the European financials, they're actually getting towards quite worrying levels. So we think that that is probably going to continue for some time. Many of the retail and institutional investors, though, seem to be pretty much stuck in the way that they're thinking for the time being, thinking that there's going to be a bounce. We think that there is probably more chance of continued downside here in the short term than there is of upside.
How would you like to define the downside?
I think the downside potentially where we're looking for the ultimate liquidity put to come in is somewhere around 1166 on the S&P futures. So we're currently above 1300. So a good 10% down below where we are right now. We're thinking on an intraday basis we could get as low as 1130. So quite a bit of a distance to still go down from there. In India, we think that that level could correspond to a break below the previous level on the Nifty, perhaps as low as 4380 if we do break down below this S&P 1285 level. But from our perspective, on Monday there was quite a significant change in view. Until then, we had thought that the central banks would try and keep the market supported to try and bring down the implied probabilities of default in the credit markets. Clearly that has not worked, and the central bank action, although it was forthcoming in the sense of countries like China cutting reserve ratios and the Bank of Japan saying that it was willing to provide US dollar funding from its reserves, it's clearly not enough. The Reserve Bank balance sheet is shrinking to the tune of about $70 billion so far this month. We think that is quite significant, and until that starts expanding, it feels like the equity markets are going to continue selling off.
Just want to get your thoughts on the way some of these emerging market currencies are collapsing, in particular the Indian rupee.
I think what has happened is that the Indian rupee is facing almost like a double whammy. On the one hand, what you're seeing is the global rise of the dollar against all currencies. So the DXY is up, the ADXY is down. So the dollar is strengthening because of the rising funding rates and a deleveraging process that is going on. So the dollar is a global funding currency that is being used to buy risky assets. And what is happening is that those risky assets are being sold and the dollar is being bought back. At the same time, India is facing some specific issues. So although we're seeing weakness in other currencies like Indonesian rupiah, in the Korean won, as well as the Taiwan dollar, what we're actually seeing in India is much more significant weakness. And I think what has happened in India is that the authorities have in a way missed a very good opportunity in the first 4 months of the year to put the house back in some sort of order. And now I think markets are questioning. Growth is slowing down. Inflation is remaining fairly stubborn in India. That ties the ability of the RBI to cut rates. And in the meantime, you've got the Indian rupee starting to fall as well. I think the lack of willingness of the government to cut the fiscal deficit has also been a thing that has got the market slightly unnerved as well.
So, Mohammed, in this scenario of gloom and doom, what is good news for India? Is it commodities? Is it valuations? It is the strong Indian domestic demand?
I think for the time being, India is going to be very much at the mercy of the external markets. One thing that has been very interesting about India is that if we go back to 2011 when the market fell, when the Nifty fell from 6,300 to 4,500, during that whole period, the net outflow from foreign investors was exactly zero. Since then, what we've seen is this year, for example, about $8 to $9 billion of money, of foreign money coming back into the market. The big question, I think, for India, both on the equity side as well as the currency side, is how sticky those foreign investors are going to be in terms of their positions. If, as we suspect, there is something like $60 billion of equity positions held in India since the start of March of 2009, if those positions start to be liquidated, then I think there could be much more of a problem ahead. At this moment, it's very difficult to know what those foreign investors were going to do. If we look in markets like Korea, for example, foreign ownership in those markets is still below the level that it was at in June of 2011, compared to in India, where we do appear to be at all-time highs.
So, Mohammed, in your India trading book, what is your current exposure? Are you short on the index? Are you protecting your long portfolio by buying protection, or you are short on the index and you're also short on individual stocks?
Well, that's a matter for our traders. I only advise on the trading strategy. My view is that the volatility in India is very cheap. So implied volatility is very cheap. We still think that that buying puts here, especially into bounces, remains the right trade. We do think that it's a bit too early to go in and start re-risking. We've actually seen some very significant interest from clients looking to put on put protection over the space of this week. I think the ferocity of this sell down has taken many people by surprise. Tonight what we have is the US and European options expiry. That has failed to provide any support to this market, and next week we could actually find the market moving in a very unconstrained manner. So there may be more trouble ahead, and I think that buying volatility at this point is probably the best way to go here.